It's flirting with tolerated. The silver bugs are angry. There's, all seven of them are angry about the fact that silver's outperformed gold, and they think in their time frames the, that it's underperformed gold. Pardon me. They think it should outperform gold. Most of the world doesn't know silver exists. My experience has been that when the generalist investor comes into a precious metals bull market, when the momentum has been established by gold, leadership changes to silver. I don't know when that will occur, but Jordan, you're not going to need me to tell you it has occurred. It's really dramatic when it does. There are some ETFs that have been pulled into the gold space because they buy stocks with earnings momentum. They've been pulled into the Wheatons and the Agnico Eagles. The generalist investor can't spell gold, despite the fact that it's a four-letter word. We haven't seen anything. At the same time that we are seeing relatively good performance by a few gold stocks, we're still seeing money flow out of the indexes. The GDX, despite being up nicely, is having outflows, not inflows. So the only generalist investors that are in the gold space are what I would call gold investors in drag, people who are doing it inadvertently in index funds. It is amazing that investor perception around gold is so muted that money, retail money, is flowing out of one of the best performing sectors in the market. This is not something that I've seen before. Well, first of all, there's been a lot of years where the GDX hasn't performed. To see the GDX perform as dramatically as it has, on the back of confirming data from the gold price itself, and see money flow out the index, is something I haven't seen before. But I have no doubt that that'll self-correct. I would argue that by valuation metrics, using current gold prices, Agnico Eagle is cheaper after it doubled than it was before it doubled. I look at discounted free cash flows, and I look at the free cash flows that they were able to generate in 2023 versus the free cash flows that they're able to generate in 2025. And by those metrics, the stock is cheaper now than it was when it was selling at half the price. Remember that part of the equation is price, but most of the equation is value. I do a couple things. I compare enterprise value, which is to say equity plus debt minus cash, and I compare that to my estimate of the net present value of the company's assets from the assets that are currently in production, and I add to that expected net present value from their project pipeline. When I do that for Agnico Eagle, I'm not going to give you the number, but despite the fact that it's gone up, it's doubled, it's cheaper than it was before it doubled. Moves in gold prices affect, first, the companies that produce large amounts of gold. You can have a junior that's looking for gold, and the fact that the gold price goes up shouldn't really matter much to them because they don't have any. If the price of something you don't have any of goes up, who cares? The second thing is, Jordan, and I've learned this the hard way, I've graded tens of thousands of portfolios, as you know, for free over 30 years. And I've learned that most people aren't willing to do the work to be speculators. They should be investors. In a gold bull market, the beta, which is to say the index itself, generates 300 or 400 or 500% returns. You can buy most of the beta in the 4 or 5 best gold companies. Maybe you underperform the average because they actually don't have the leverage that the lousy companies do. But you can buy 85% of the beta for 10% of the risk by buying the best of the best, and then you can get on with your life. You can go fishing or go gardening or read books or play with your kids. And for people who aren't addicted to it like me, that's a good answer. That's a good thing to do. The best in terms of risk to reward, I think, are the pre-feasibility developers with 5 million ounce or more deposits. I look at Snowline. It's up 1,000%, but it's still cheap relative to what they have. It's likely to stay cheap until they announce permitting and construction. So if you're looking at it in a 6-month time frame, you may be very unhappy. If you look at it over the course of a bull market, or minimally in a 4 or 5 year time frame, 10 million ounce deposits of 2 gram plus material are very rare beasts. So things like that are attractive to me. The sector that's always the cheapest relative to probabilities is the prospect generators, because the narrative is too commonsensical for exploration speculators. The idea that the business is a knowledge business, not an asset business, and that you don't dilute yourself at the company level, which is the knowledge level, but rather you dilute yourself at the asset level, which has a 1 in 3,000 chance of coming true. Those are always the best relative values. And over the 5-year time frame, confining your investments to the prospect generators to the expense of every other single class likely gives you the best risk adjusted rate of return in the space. Very few people are willing to give up the adrenaline rush of drill hole play exploration in favor of the pure arithmetic of prospect generators. And I have to admit that I don't do it either. I would be better off probably if I confined myself to owning 9.9 or 19.9 of every prospect generator and did nothing else. But then I'd have too much spare time. I wouldn't be able to confine myself to arithmetic sanity. There's a whole bunch of silver dross out there, little companies whose real exposure to silver is confined to the fact that they have silver on the name of the company and the share certificate. The price of something goes up and you don't have any. It shouldn't matter very much, but I guess sentiment matters. The phenomenon that you describe is extremely important for people to understand. I experienced it personally in the early part of the decade of the 90s, where I was part of the genesis of both Silver Standard and Pan American Silver. Those two companies escalated from our first financings, 50 cents on Pan American and 72 on Silver Standard, to 5 or 6 years later, plus $40 bids. People don't understand the upside in legitimate silver juniors. They're the most volatile asset class in resources that I know of. The caveat is that you have to be involved not merely with narrative, but with high quality people, with Ross Beatties and Bob Quartermains, and high quality deposits. There are a few of those out there. I would suggest that Abra is high quality. I would suggest that Vizsla is high quality. I would suggest that Aya is high quality. And there are a couple others knocking on the door. As you suggest, a couple of the small producers, Gatos and Silvercrest, got gobbled up. That's okay. Got paid a nice premium. If you wanted, you could take shares in the acquirer so that in the run-up in silver prices, that deposit will continue to benefit you. But there's a lot to be said for doing the work to establish a 5-stock position among the silver juniors, and then just relaxing until the generalist investor comes into space. I've never seen a frenzy around anything, with the exception of uranium in 2002, that resembled the silver frenzy, the junior silver frenzy that I experienced in 1992, 1993, 1994, and 1995. It was unlike anything. I was identified as the sort of promoter between Pan American and Silver Standard. And institutional investors would call me up saying, "How are you doing this?" And I would say to them, "Well, that's a trade secret. It's not available." The truth is, I wasn't doing anything. The market went absolutely crazy. A bull market, what happens in a bull market, for people who were early in the bull market, they bought a narrative before the narrative came true. And as the narrative begins to be demonstrated by the price appreciation of the product in hand, that very price appreciation justifies the narrative. But that price appreciation devalues the narrative. In other words, if you think the gold price is going to triple, and then the gold price triples, your narrative is done. Perversely, you believe in it even more because you feel good, particularly if you were tested early in the period. I, as I've told you, Jordan, came into the market in the 1970s, the wildest bull market that resources have ever seen. I had the good fortune to come into it very early. And because I was naive, I played it very aggressively. And as a consequence of playing it aggressively, I outperformed many people who were substantially smarter than I. And I came to believe, perversely, as a young testosterone-driven male, that my performance had to do with my genius, ignoring the fact that the gold price went from $35 to $850, and the oil price went from $2 to $30. And I ignored, too, the fact that markets work, that the cure for high prices, including commodities, is high prices, including commodities, and that the market would correct. And come about 1982, When that commodity bubble burst, I learned just how smart I was, which is to say, not very. The good news is that I have been able to guard against my own hubris ever since. I have been able to say, Rick, is this getting too easy? You are starting to make money on your mistakes. Do you remember how bad you felt when you went from being a wealthy young man to having a negative net worth? The answer to that question, by the way, is yes. And I have managed ever since 1982 downdraft, I have remembered to take advantage of the bull markets. I remember once in Midland, Texas, after the crash in oil that occurred in the mid 80s, seeing a wonderful bumper sticker on a car. Said, God, one more bull market. I promise not to waste this one. And I remind myself of that, just like I reminded myself a couple of weeks ago that the reason that I had bought added positions in the uranium juniors was because they were going to overcome hate. And for that part of my position, not my whole uranium position, but the part that was bought in anticipation of overcoming the hate, when that goal was met, I had to sell a stock.